Well, hey there, everyone. Happy Tuesday. Hope you are having a great day. I am so excited to be here for our Tip Tuesday. And today we are talking all about business taxes. So before I get started, let me know who is here. And also, don't forget, if you have questions as we go through, feel free to just drop them in the comments. I'm more than happy to answer them. And let me know that y'all can hear me too. I'm always nervous that I'm going to just talk for 15 minutes and you're not going to have a clue what I'm saying. So let me know. But I'm going to dive in because today's topic is everything you need to know about business taxes in 15 minutes. And I will admit it was a little optimistic of me to put 15 minutes. Chances are probably going to take me a little bit more like, oh, perfect, you can hear me, great. Probably going to take me a little bit more like 20 minutes, but we're going to do this pretty fast. I want to caveat this by saying this is just an overview. Obviously, I'm not getting into every fine little detail on all of the different things I'm going to talk about today. So again, if you have questions, put them in the comments, or if you feel like you need more support, you can always reach out to me and I can share with you the ways that we can work together. This is really just meant to give you that overview if you're newer to business, or if you've been in it a while and you're just kind of nervous that you're missing something. This is going to give you that overview of everything you need to be aware of. So, all right, let's go ahead and dive in. Let me go ahead and share my screen here. And nope, hold on. Almost there. There we go. Awesome. Okay, I always have to change the background here so it's not like funny looking. Let's go ahead and dive in. So everything you need to know about business taxes in 15 minutes or maybe a little bit longer. So first off, let's just talk about how taxes actually work as a small business. It depends on the type of legal entity you are, or if you're a legal entity at all. So if you are a sole proprietor, which is just by default what you are, if you haven't formed a legal entity, or if you run your business out of an LLC, a partnership, or an S corporation. By the way, an S corporation is not a legal entity. It's just a tax status that your legal entity, like your LLC, elects to be classified as. But if you're any of those things, then the profits or losses from your business are going to do what we call roll up to your individual tax return. So they're not going to get taxed at the corporation or the business level. They're going to get taxed and reported on your individual tax return. And by definition, by consequence, I can't think of the right word. As a result, they're going to be taxed at your individual tax rate. So if you're, if you make enough money so that your next dollar of income is taxed at 28%, then the profits coming from your business will be taxed at 28%. It's your individual tax rates that matter at that point. The entity does not pay taxes itself. So if you are an LLC, the LLC isn't paying taxes. Those profits are rolling up to you as an owner of that LLC, and you're paying taxes on those. Now, if you are a multi-member LLC, multiple people owning it, if you are a partnership or an S corporation, all of those entities need to file what's called an information return. So the entity, again, doesn't pay taxes for itself, but it does need to file an information return reporting its income and a few other items to the IRS. It's solely informational. Now, if you are a C corporation for your business, or just corporation, you have an elected S corporation status, then you are taxed at the entity level, meaning the business itself is going to pay taxes. It's going to file its own tax return. It's going to pay tax on the profits that the business itself makes. The one thing I want to point out with a C corporation is that you actually end up getting double tax as a shareholder, because not only does the business pay taxes on its profits at the business level, but when dividends are paid out to you, you get cash out of the company, you as an individual are also going to pay taxes there. So there's pros and cons to being a C corporation. That's one of the cons, but I just want to point that out. But for most of you, your profits are going to roll up to your individual tax return, and you're going to pay tax on those profits at your individual tax rates. Okay, so the types of taxes I want to talk to you about today, and these are generally the types of taxes you need to be thinking about, are income tax, self-employment tax, payroll tax, sales tax, excise tax, and property tax. Keep in mind that I'm going to be talking about most of these at the federal level. There are also some of these, or many of these, at the state level too. Depends entirely on what state you live in and or what state you operate your business in. Now, the other thing I want to mention, especially when we get down to the state level, is that some of these taxes, like excise tax or sales tax or property tax, might have other names. So I'm going to use the generic names for them, but just keep in mind that your state may have a very specific name, probably going to act very similar to what I'm describing, but it just might be called something else. So let's start off with income tax. This is kind of the obvious and easy one, right? So in terms of your business, the income is going to be all of your sales, all your revenues, all the money you take in. Now, you also get to take what we call tax deductions. So deductions are qualified business expenses. There are some exceptions, but generally, if you spend money in your business, if you buy software or office supplies, or you pay for internet, those are all business expenses. So you get to subtract those from your business income, and that's going to get you down to your taxable income. So your income minus your deductions gets you to your taxable income. Now, the amount of tax you pay on that taxable income is just a percentage. And there are some pretty fancy tables and charts if you go to the IRS website, because we have different tax rates as your taxable income increases. So it's not just one flat number at the federal level. Many states have a flat percentage at their level. I do also want to mention, and I said this before, the rates are based on your individual tax rates, but I also want to mention that when we're thinking about our business profits and the tax we're going to pay on them, because we're including this income in our individual tax return, it actually gets aggregated with all of the other types of income that we report on our individual return. So for example, if you have a business and you also work as an employee somewhere, that you're going to take those employee wages and you're going to take your business income, and that all gets pooled together. Or if you have a spouse that has income, or you got some investment income, or you got unemployment, for example, 2020, that happened to a lot of us. So all of your income gets pooled together, and then the tax rate is applied to that total bunch of income. That this trips people up a lot, because sometimes what will happen is someone will go into business and they'll make some money and they'll look at the tax rates and they'll say, oh, okay, I made X amount of dollars, so the tax rate for that is 15%, so that's what I'm going to set aside. But they don't think about the fact that their spouse already has income. And oh, by the way, spouse has $100,000 in income, which now actually bumps up your tax rate on your business income. Your rate isn't 15% anymore. Now it's 25 or 28, depending on where you're at. So just want to make sure that doesn't trip you up. All right, our second type of tax we're going to talk about today is self-employment tax. Basically, self-employment tax replaces payroll taxes. If you were ever an employee, you had payroll taxes taken out, that's what self-employment tax is. Self-employment tax collectively is the employer and the employee portion of payroll taxes. So when you were an employee, you may not have realized this, you had money taken out of your paycheck for payroll taxes like Social Security and FICA and Medicare, right? But your employer also had to pay that same amount from their own pockets as well. So that collectively are your self-employment taxes. So it includes 12.4% for Social Security, up to $142,800 in wages for 2021. That amount changes every year. It includes 2.9% for Medicare, and that total is 15.3%. Now, you do get a 50% deduction for the employer portion. So half of your self-employment tax you actually get to deduct. So your total tax hit isn't actually 15.3%. It's less than that, because you're going to pay 15.3%, but then you're going to get half of that amount as a deduction off of your taxable, or to get to your taxable income. Okay, so self-employment tax is reported on your individual tax return. It's paid in with your quarterly tax payments. We're going to talk about those in a second. Very much like you would pay in income tax. All right, let me know if y'all have any questions so far. I know I'm going fast. I got 15 minutes. All right, so your quarterly estimated tax payments, these are actually required for your income and your self-employment tax if your total tax liability for the year is $1,000 or more. Now, I want to just make this very clear, because people get really hung up on this idea of estimated tax payments. And why do we have to pay them at all? So the rule is actually that you owe tax as you make money. So I make $1,000 today, boom, I owe tax on $1,000. But the IRS is generous and they say, we're not going to make you pay tax every single day. That would be really cumbersome, right? So instead, we'll let you pay tax every quarter. Now, when you're an employee and you have taxes taken out, your employer pays those taxes into the system, right? That's what the IRS says employees can do. But when you're a business owner, they say, we're going to give you actually until the end of the quarter to pay those taxes in. So that's what your estimated tax payments are. So at the end of every quarter, we basically need to sit there and say, okay, what do we estimate we're going to owe this year in income tax and self-employment tax based on what we've earned so far? So if you're in Q1, you're going to take the amounts you've earned in Q1 and you're going to do what's called annualize them, multiply them by 4. So if I made $25,000 in my first quarter. And by the way, I'm talking about profits, your income minus your deductions to get to your taxable income. I'm not talking about revenues. So I'm talking about your taxable income or your profits. If I make $25,000 in that first quarter, I'm going to say, okay, based on that, I'm probably going to make $100,000 this year because $25,000 in one quarter, 4 quarters, $100,000. If I make $100,000 in taxable income, that's going to result in a tax liability of X, depending on the percentage, right? And so then I'm going to want to pay in 1/4 of X every quarter. Now, as the year goes on and we have more and more quarters, that number gets more and more refined, right? Because most people's businesses are not so perfectly set up to where you're going to make the exact same amount of money every single quarter. So as we go on throughout the year, that number is going to get more and more refined. But that's how you actually figure out what you're going to owe for the year. And then you basically pay in 1/4 of that amount every quarter. Now, there are what we call safe harbor rules. Safe harbor rules basically say that as long as you pay in a certain amount of money, then we will not charge you penalties if you owe more money in April. You still need to pay the money you owe. The IRS just isn't going to charge you penalties on that amount. So the safe harbor rules are that you have to have paid in at least 100% of your prior year liability by the time you file your return in April, or if you file it earlier, by the time you file your return, or 90% of your current year liability, what your current year liability ends up being. Now, it's actually 110% if your adjusted gross income, which is a fancy term on your tax return, if your adjusted gross income is $150,000 or more. So just keep that in mind. It's 100% of prior year unless your AGI, adjusted gross income, is 150K or more, then it's 110%. But so what a lot of people will do is instead of looking at every single quarter and calculating it and trying to figure out exactly what they're going to owe for the year, is they'll say, let me just pay in based on the safe harbor. I know I'm going to probably have to pay some in April, but at least I'm not going to get penalties on that. Now, pros and cons to that. The pro is it's easy to do, right? You don't have to do this big calculation every quarter. Couple of cons. Con number one, if you're not prepared, you may end up owing a lot of money in April. And so if you haven't been setting cash aside, you may be unprepared for that. The second con is, let's say you actually made more money last year. So if we were doing this for 2020 and 2019 was a good year for you, and then all of a sudden 2020 hits and COVID and your business takes a hit, you wouldn't want to do the safe harbor because you would be paying in based on last year when you did really well, instead of on this year when your income has gone down. So if your income is going to be less in this current year, you probably don't want to pay in based on last year. Okay, so just a couple of things to think about there. Any questions on estimated tax payments, just drop them in the comments. I'm going to keep going, but let me know, okay? All right, so our next type of tax is payroll tax. Now, this only comes up if you have employees of your business. And also, by the way, if you do elect S Corp status and you put yourself on payroll, then this comes up as well. So you got to do a couple of things with payroll taxes. I didn't put them on this slide, but you obviously have your employee portion of payroll taxes, right? So you have to take the money out of their paycheck and hold it and then pay it in to the IRS and the state, if the state has payroll taxes, on their behalf. So that's one piece of it. But you also have to pay the employer portion. And remember, this is half of those self-employment numbers because those self-employment tax numbers represent the employee and employer portion. So half would be 6.2% for Medicare, again, up to that $142,800 in wages, and then 1.45% in, I think I said Medicare before, that was Social Security, 1.45% for Medicare, which is on just all income. And these are amounts you actually have to pay. So when you're hiring an employee, make sure you realize you're going to have to pay these amounts. Now, how often you pay these depends on a couple of things, and primarily on your total tax liability, payroll tax liability as a business. But generally it's monthly or semi-weekly. You figure this out when you basically register with the IRS and or the state to submit payroll tax filings. They'll tell you your filing frequency. So just keep that in mind. I highly recommend, if you have payroll tax that you need to worry about, I highly recommend using a payroll service like Gusto or JustWorks that will automatically calculate the correct amount, take it out of your employee's paycheck, take the correct amount from you, and then pay in those payroll tax filings on your behalf. It is worth every penny. Even I'm the only employee in my business. and I'm an S Corp, and it's worth even just to do for me for my payroll, okay? So I highly recommend doing that and not worrying about doing that manually. Sales tax. Now, sales tax is one of the most complex areas of tax, and this honestly is the one that overwhelms most people. The rules vary by state. Every single state has different rules on how they do sales tax. And by the way, I didn't put this on this slide, but if you sell internationally, they have their own version of a sales tax, which is actually called VAT, or value added tax, which operates sort of similarly, but also really different and is also really complex. Now, with sales tax, taxes are collected from the buyer, the person buying whatever is subject to sales tax, but the seller, you or I, is responsible for paying that amount to the respective state. Now, here's why sales tax gets so complex. It's based on where you have what's called nexus. Nexus shows up in one of two ways. Nexus is basically presence. You have some kind of presence in the state. Nexus can be physical, meaning you have an office, or you have an employee that works there, or a salesperson, or you have a retail store that works there, a retail shop that is open there and sells there. Or it can be economic, meaning you sell a certain number of transactions or dollars into that state. So, and by the way, with economic nexus, most of the states that have it, that minimum required to have economic nexus in that state is like 50,000 or 100,000. So it's a decent number. It's a big enough number. So if you're selling $100 to somebody in one state, you don't usually have to stress. But the reason why sales tax gets so complicated is because you can have nexus in multiple states. My business is run out of Massachusetts, but I could potentially have nexus in all 50 states, depending on where I'm selling to, what my operations look like, and all of that. Every state in which you have nexus, you potentially have to collect and pay sales tax. Now, the second question after you determine where you have nexus is, well, is what I'm selling even subject to sales tax in that state? And by the way, those rules differ all over the 50 states too, okay? So it's not the same rules for everybody. So then you'd look at, okay, is what I'm selling actually subject to sales tax? And then assuming it is, then you would need to register for sales tax in that state, and you would need to collect and file in that state, collect and pay in that state, excuse me. So sales tax is a very complex area. And I generally recommend that you talk with your CPA or with your accountant about this to figure out exactly what you need to worry about. The good news is, most of us, at least in this community, probably don't need to worry about sales tax, but I still recommend you have the conversation so that at least you have it documented, that you did the analysis and you've determined you don't need to worry about this. You're not subject, and here's why. It won't completely protect you, but it'll not only give you peace of mind, but it'll also give you a bit of protection potentially against penalties if you ever find out, oh, actually we are subject to sales tax. Cool? All right. I mentioned all this already. I forgot I had this slide. So there you go. But I do want to mention this one point, that a lot of times people think about sales tax in reference to just physical products like, phones or books. Sales tax can absolutely be charged on digital products like courses, like ebooks, things like that. And there are states that actually charge sales tax, or they may not call it sales tax, but they'll call it something else, on services as well. So you can't just say, oh, I'm a service-based business, or I only have digital products, I don't have to worry about sales tax. You might. Now, again, more often than not, you'll probably be fine, either because what you sell isn't subject to sales tax, or you don't sell enough of it to create nexus in that state, or in a different state. But again, it's an analysis that's worth just going through once so that you at least know where you stand. Cool? Okay, we're almost done. I'm so close. I think I'm like right at 15 minutes, I think, right now. So I'm actually not doing so poorly. All right, so let's talk about some other taxes to wrap this up. Excise tax. This is a big one that a lot of people don't know about, and it can throw off some folks. So excise taxes are consumption-based taxes on specific goods. Now, we have these at the federal level and possibly at the state level as well. These, typically where we see this show up for businesses, is they will charge an excise tax on property that you buy. For example, like if you buy a vehicle for the business, they might charge an excise tax. For example, here in Massachusetts, we have excise taxes every year on our vehicles we have to pay. So if your business has a vehicle, you might have to pay this. But it's not just limited to that, and you've got to look at your individual state to see what is potentially subject to their excise tax if they have one. Now, the second type of tax, at least in terms of assets, is property tax. Now, this is tax on real property. If you own a home, this is a concept you're probably very familiar with if your state has property taxes. Well, in states that have property taxes on real property, buildings or structures, they also typically charge those taxes on those structures that are owned by businesses. So if your business owns a building or owns any kind of real property, then potentially you're going to be subject to property tax. Now, property tax is almost always imposed at the local level. So your town, your city, your municipality, maybe your region. This isn't a federal level thing, so you definitely want to check where you are located. And then lastly, a lot of places will have, and this is a state tax, typically at the state level, will have a tax that's like an asset tax or a wealth tax, or it might be called a franchise tax. California, Delaware, a bunch of states have franchise tax. These are taxes on your total assets, and these are business taxes, okay? So if you live in a state that charges one of these taxes, they're typically going to look at the total assets of your business, and they're going to charge usually a percentage on that. And there's almost always a minimum that you have to pay. So for example, like Massachusetts has something like this. And what is the minimum? I think it's $456 here. Delaware, I believe, has a minimum. California has a minimum. So a bunch of these states have minimums. So even if your business doesn't have a lot going on, depending on the type of entity you are, LLC, corporation, whatnot, you may be subject to one of these taxes. So just keep that in mind as well. Again, that's a state level tax typically. So you're going to check with your state to find out what you might owe for that. Cool? All right. So just want to leave you with a few tips for tax time. And I say tax time, but really when we're business owners, tax time can actually be any time of the year. Because yes, our income tax and our self-employment tax, we do quarterly, and then we do when we file our return in April. But if you have payroll tax filings, those could be monthly. Same thing with excise tax or property tax, or these asset taxes, those could be different times of year as well. So this isn't the kind of thing where you can just say, I don't need to worry about anything until April. I'm good. What I highly recommend doing is basically getting a calendar or putting it on your calendar and marking down when all of these different things are due, because they can creep up. And if you miss them, oftentimes there are penalties. But my first tip for you actually is to set an accounting system, whether it's something that it's like super built out, like a QuickBooks that has a ton of features, or I think y'all know I highly recommend Wave Apps, waveapps.com. It's completely free. It's a great tool. It's easy to get set up. Have some kind of system that is tracking all of the numbers in your business. It's going to make it so much easier when it comes to making these calculations, especially for those estimated tax payments. When you've got all the numbers in one place, they're super organized and you don't have to go digging around for them. Now, I also recommend that you keep good documentation. This can be in the way of receipts or contracts or invoices or whatnot, but just making sure that you have documentation to back up some of this stuff, especially when it comes to those business expenses. Because if the IRS ever came in, or the state ever came in and questioned, having that documentation can help substantiate that it is a legitimate business expense. Now, I also recommend you set aside time to do your quarterly tax calculations. I put this in my calendar once a quarter, just usually a few days after the quarter ends. I put a couple of hours in there to sit down, do those calculations, and make those payments. That way I don't, I'm on top of things, and I don't have to worry come April that I'm going to have all of these huge penalties because I haven't paid anything in at that point. Lastly, I recommend setting up a separate bank account for your tax savings. This way, on a regular basis, and I usually recommend once a month on a regular basis, you're moving money to that tax savings account so that you've got money saved when it comes time to pay in those quarterly taxes and or the year-end taxes. But that way you're doing it as you're making money on a consistent basis, and you're not scrambling at the end of the year trying to figure out how to pay a huge tax bill. Cool? All right, friends. Nope, I've got one more. I knew I would talk about the tax plan somewhere. So let's talk about the tax plan real fast. So I kind of mentioned this thing about putting it into your calendar, all the different dates. But there's another piece of your tax plan as well that I want you to think about, and that's actually deciding who's going to do all these different taxes and how you're going to do them. So first thing to decide is if you're going to DIY it or if you're going to hire someone to prepare your taxes. I highly recommend if you're going to hire someone that you don't wait until the last minute. We're now recording this in mid-February, and most CPAs I know are fully booked, not taking on new clients. So you definitely don't want to leave it till the last minute if you do want to work with somebody. But even if you're going to DIY it, don't leave it to the last minute either. You want to leave enough time so that you can get all the information together, you can enter it into the system, you can step away from it, come back, review it, and then still have time if there's stuff you need to follow up on. I already talked about put those deadlines in the calendar. And then what I would do once those deadlines are in there is actually block off times in advance to do all those steps I just talked about, to get the documents, to put the information, if you're going to use a tax prep system, put them in there, to to prepare the estimated tax calculations, to review your tax returns, all those different things, kind of walk it back, right? And then make sure you have enough time to do each of those in your tax plan. But having a tax plan in place is so important because it means that you won't be scrambling on April 14th trying to figure out what the heck you need to do. Cool? All right, now we're done. Now I've got everything for you. So if you are looking for someone to do your taxes, I do still have just a couple of openings left. You can learn more about my tax prep packages by going to megkwheeler.com/tax. But I will tell you right now, they include all of your tax preparation needs for your income tax, for you personally and for your business, as well as a lot of ongoing support and guidance. So my tax prep package right now includes your 2021 annual tax return prep, which happens next year. It includes your 2021 quarterly tax calculations, all those estimated tax calculations you need to do. It includes 4 quarterly tax planning calls. It includes ongoing tax support for the entire year. So anytime you have questions, you can send me a voice message or you can send me a message through our client portal. There's no extra charge for that. It's part of your package. Plus, when you sign up, basically within the next week, it will include your 2020 tax return prep as well. So I'm basically bundling the 2 years for you. So we'll do your 2020 tax return prep now, then you'll get all of this ongoing support going into 2021. And you won't have to worry about your tax stuff for basically through next April, which is pretty cool. So again, you can get all the details by going to megkwheeler.com/tax. I don't see any questions here, so I'm going to just wrap it up. And I will see you all, if you're a member of the Badass Moneymakers, I will see you all back in our group on Thursday for our weekly Q&A. Otherwise, to the rest of you, I will see you here next week for another Tip Tuesday. Bye for now.